take a look at the factors that impact floating exchange rates. These can be characterized as long-term and short-term factors. One of the important long-term factors that impact exchange rates is balance of payments. If a country imports more than it exports, it creates a trade imbalance. Since independence, India's imports, largely oil and gold, have far exceeded its exports. When imports exceed exports, there is a trade deficit or the balance of payments is negative. When this happens, it increases demand for foreign currency in the country. This excessive demand for the foreign currency pushes up its value vis-a-vis the domestic currency, which weakens. So, for example, in 1987, $1 was equal to approximately 13 rupees. Today, it is equal to almost 54 rupees, largely due to our trade imbalance. Another factor impacting exchange rates is the current account deficit. In addition to trade flows, the current account deficit includes inflows and outflows for FDI, FII flows, royalties, dividends, interest payments, and expatriate remittances. In short, all foreign exchange inflows and outflows. A country may well have a balance of payments deficit, but a current account surplus caused by these flows. In such a case, the domestic currency will not be negatively impacted by the trade deficit or the negative balance of payments. You may recall that in 2007, India had a trade deficit. We've always been importers. But we had a current account surplus. Remember that there was a large amount of FDI and FII inflows coming into the country. So whilst we had a trade deficit, we also had a current account surplus. So this actually resulted in the rupee becoming stronger from a level of almost 47 rupees to the dollar to 39 rupees to the dollar. It's also important to look at the current account deficit to GDP ratio and is a very important indicator of the country's ability to meet its foreign currency liabilities.